Welcome to the Deep Dive, where we unpack complex topics to give you the essential insights you need, fast. Today we're taking a deep dive into the fascinating world of currency markets, drawing from your sources, specifically a comprehensive guide on day trading and swing trading the currency market. Our mission? To extract the most important nuggets about how these markets work, what truly moves them, and how experienced traders approach them.
It's a dynamic and, yeah, often misunderstood corner of the financial world. We'll explore everything from its unique structure and efficiency to major historical events and practical strategies. You're about to get a shortcut to being truly well-informed about foreign exchange. Okay, let's unpack this. Why the FX market stands out. Its unique attributes.
So let's kick things off with the big picture. Why is the foreign exchange market, or FX, considered the fastest growing financial market of our time, and what makes it so, well, uniquely attractive to traders?
Well, one of the primary reasons is its sheer accessibility and efficiency. Unlike, say, traditional equity markets, the FX market operates 24 hours a day, and it has around-the-clock liquidity. This continuous operation eliminates many common issues you find elsewhere, creating a truly unique trading environment.
That sounds compelling. What are some of those key advantages that truly set it apart?
First off, the transaction costs are significantly lower. I mean, in equities, you face noticeable spreads and commissions that can add up pretty quickly. But in FX, because it's an over-the-counter market, meaning trades happen directly between two parties rather than through a centralized exchange, you cut out exchange and clearing fees. This direct dealing with market makers can save an active trader, well, potentially hundreds of dollars daily just in transaction costs.
Okay. And what about those regulations that can halt trading in other markets? Things like trading curbs or uptick rules. What's the impact of not having those in FX?
Oh, that's a huge difference. Trading curbs are temporary halts, right? Designed to slow down rapid price moves. And uptick rules mean you have to sell higher than the last price. In FX, trading is never halted due to these types of regulations, which means no missed profit opportunities from some unexpected stop. You can place trades 24 hours a day, virtually no disruptions. Plus, online trading really cuts down on error rates compared to the, multi-step process in equities involving brokers and exchange specialists. That can sometimes lead to getting filled at a less favorable price.
So it's faster, more efficient, less regulated in certain ways. It sounds like the FX market also has characteristics that make it particularly suited for different analytical approaches too.
Absolutely, yeah. For technical analysts, currencies rarely stay in tight ranges. They tend to develop strong, identifiable trends. And since over 80% of volume is speculative, you get frequent overshoots and corrections. That provides multiple entry and exit opportunities. Common indicators like Fibonacci retracements, for support and resistance levels, stochastics for momentum, METZ-D for trend strength, RSI for overbought, oversold. They have all proven pretty valid here.
Okay. And for the fundamental folks?
Equally appealing, really. You can almost analyze countries just like stocks. Think of a country's GDP like a stock's growth rate, industrial production like inventory ratios, retail sales like sales figures. Currency prices, fundamentally, they just reflect supply and demand, primarily driven by interest rates and overall economic strength. You see that reflected in indicators like GDP, foreign investment, trade balance. It's about understanding the underlying health, of an economy.
Oh.
A walk through FX history. Key milestones and crises.
Right. Now, the FX market as we know it today didn't just appear overnight, did it? It has a rich and, frankly, often turbulent history. Let's maybe start with some foundational moments that really set the stage for where we are now.
Indeed. After World War II, you had the Bretton Woods system that fixed exchange rates to gold, creating a relatively stable but pretty rigid environment. That system eventually gave way to the Smithsonian Agreement in 1971. Which attempted to maintain fixed rates without gold, letting the dollar float within a wider 2.25% range against other currencies.
Okay, so how did that attempt at stability without the gold standard actually play out?
Well, it ultimately proved unfeasible. Without exchange rates fixed to gold, the free market gold price just shot up. The U.S. trade deficit kept growing, and the dollar needed to devalue beyond what the agreement allowed. Foreign exchange markets were actually forced to close temporarily in February 72. They reopened in March 73, completely unbound by the agreement. The U.S. dollar's value was then determined entirely by the market. And this ushered in an era of pretty crazy inflation, coupled with economic stagnation, what we now call stagflation.
Wow. That shift from fixed to floating rates was monumental. And it leads us, I think, to one of the most talked about figures in FX history, George Soros. Tell us about the man who broke the Bank of England.
Right, Soros. So in 1990, the UK joined the exchange rate mechanism, the ERM. This tied the pound to the German Deutschmark, basically subjecting it to the Bundesbank's monetary policies. Germany started aggressively increasing interest rates in the early 90s, but due to national pride and its commitment to the ERM, the UK felt it couldn't devalue the pound to stimulate its own economy.
So a bind.
Exactly. Then comes Black Wednesday, September 16th, 1992. George Soros leveraged billions of dollars, selling a huge amount of pounds. Reports say around $10 billion worth betting against the ERM. The pound just plummeted, about 5% or 5,000 pips in just 24 hours. It forced the Bank of England to devalue its currency and ultimately pull out of the ERM entirely.
Wow, that's an incredible story of market power. The insight there seems to be how speculative capital, if it's big enough, can really reshape economic realities, even challenge a government's control. Were there other major crises that kind of highlighted these market forces?
Oh, absolutely. The Asian currency crisis of 1997-1998, that saw widespread banking breakdowns, huge non-performing loans, particularly in South Korea and Japan. Asset prices there fell by, I think, a staggering $10 trillion. The Thai baht was devalued by as much as 48%. The Indonesian rupiah plummeted something like 228% from its high. Even among the majors, the Japanese yen fell about 23% against the US dollar. These crises really showed how interconnected global finance is and just how fast economic problems can spread.
So we've seen crises reshape the market. But equally transformative were deliberate political shifts, right? Maybe one of the biggest moves was creating the euro. How did that foundational change impact the global FX landscape?
Yeah, the euro launch in 1999 was huge. It followed the Maastricht Treaty's convergence criteria, strict limits on government deficits, debt, inflation, exchange rate stability, all that. Now, while it brought benefits like price transparency and made the region more attractive for foreign investors by creating this unified bloc, it also meant member nations gave up their independent monetary policy. And that's led to challenges, when the European Central Bank's actions, which are set for the entire Eurozone, don't quite align with what individual countries need. That causes significant political pressure sometimes. 3. What really moves the market? Beyond the obvious.
Okay, so with such a complex, interconnected market, how do traders actually figure out what's going to move currencies? Is it all about the big news announcements, or is there more to it?
Well, not all economic data releases are created equal, and their impact can definitely change over time. For the US dollar, sources consistently show the non-farm payrolls release has been the #1 most market-moving indicator for years. It often caused significant, really rapid movements, sometimes around 70 pips in the Euro USD within just minutes of the release. That shows its immediate impact.
That's fascinating. So something like GDP, which sounds incredibly important, isn't always the biggest mover then.
Exactly. Yeah, surprisingly, the GDP report isn't actually a very market-moving indicator for the US dollar anymore. Often has less impact than other data points. Could be because it's released quarterly and maybe many of its components are already known in advance, so the market might have priced it in by release time.
Right. We've talked about different approaches like technical and fundamental analysis. What theories try to explain currency movements over the long term and, how well do they hold up?
Several models attempt this. You've got the balance of payments theory. That suggests exchange rates should ideally be at an equilibrium point, one that produces a stable current account balance. So countries with trade deficits, theoretically, often see their currency depreciate.
Makes intuitive sense.
It does. However, the asset market approach probably holds more sway today for major currencies, especially the US dollar. It really emphasizes capital flows, money moving into or out of a country's stock and bond markets as a primary driver. Often, it seems to trump trade deficits. There was a time, for instance, the dollar plummeted sharply against the yen as equity investors fled U.S. markets, even though the trade deficit was still massive. It highlighted that capital flows can be way more influential sometimes.
Okay, so capital flows are key. What about other models?
Well, others like purchasing power parity, PPP, that compares price levels of a basket of goods across countries, and the monetary model linking high interest rates to inflation and a depreciating currency, they have limitations. They don't fully account for factors like tariffs, capital flows, or, the strength of equity markets. The interest rate model also tends to maybe overemphasize capital flows at the expense of things like political stability, inflation, and growth, which are also vital.
Let's connect this to some real-world examples. How do things like equity markets or commodities actually play a role in currency movements?
There's often a strong correlation between a country's equity market and its currency. A rising stock market typically attracts investment dollars, right? boosting the currency. Historically, a strong equity market often comes before currency appreciation. And then you have the commodity currencies, like the Australian, New Zealand, and Canadian dollars. Their movements are often closely tied to commodity prices. Gold, for example, is often called the anti-dollar. When the dollar goes down, gold tends to go up as investors seek a safe haven. Currencies like AUD, NZD-USD, and USD-CHF often mirror gold's movements somewhat. Oil's correlation with the Canadian dollar is, well, a bit more complex. It shows a weak negative correlation, actually. Canada is both a producer and a significant consumer of heating oil, so it's not straightforward.
So traders are watching economic data, equity markets, commodities. What about direct intervention, central banks stepping in? How powerful is that?
Central bank intervention, although maybe less frequent for major currencies now than it used to be, can still have a profound impact. Yeah. The Bank of Japan, for instance, once spent trillions of yen intervening to stop the yen from appreciating too much. It effectively created an invisible floor under the USD-JPY pair. Intervention can trigger sharp moves, 100 to 150 pips or even more, very quickly, taking out lots of stop orders along the way. This means traders should probably try to play intervention, use the warnings as a signal to trade with the central bank, and definitely avoid fading intervention betting against it because the risk is just too significant.
Don't fight the central bank, basically.
Pretty much. Additionally, bond spreads can be a useful leading indicator for currency movements. These are essentially yield differentials, the difference in interest rates between the two currencies in a pair. Large investment banks, hedge funds, they actively shift funds from lower yielding to higher yielding assets. That influences currency flows. This tends to work better over longer time horizons, but shifts in short-term interest rate expectations can also signal upcoming currency price changes. 4. Mastering the trade. Strategies and self-awareness.
Okay, knowing all these complex market dynamics is one thing, but how do successful traders actually apply this knowledge in practice? What's the foundational advice for someone trying to navigate this market?
Right. Well, the most important first step for any trader, I'd argue, is to create and consistently use a trading journal. Seriously. This isn't about finding some holy grail indicator. It's about developing self-discipline and, crucially, self-awareness. Like how presenters might record themselves to eliminate ums, a trading journal helps you spot patterns in your own behavior. Things like taking profits too early or letting losses run too long. It gives you insights no software can.
That makes a lot of sense. So what should a good trading journal include? What goes in there?
Typically, it has 3 key sections. One is a currency pair checklist. Just to get a daily feel for the market, identify trends. Start with the majors, USD, USD-JPY, USD-CHF, GBP-USD. Then a list of trades I am waiting for. This helps ensure you're sticking to your predefined plan, not just jumping in. And finally, existing or completed trades. This is where you review. Learn from successes and mistakes. The whole goal is to avoid trading blindly and really understand the market environment and your own performance within it.
Okay, so journaling for discipline and learning. Beyond the mechanics, though, you mentioned psychological outlook is crucial. Why is that just as important as understanding charts or economic data?
Because traders who can't cope with the stress of market fluctuations simply won't last. Regardless of their technical skills, you have to be emotionally balanced. Basing decisions on strategy, not on fear or greed, it's essential to accept that losing trades will happen. It's part of the game. The key is to make those losses small. If you find yourself on a losing streak, sometimes the best thing you can do is just take a break. Step away, clear your mind. We often recommend aiming for at least a 2.1 reward-to-risk ratio, meaning you aim to gain twice as much as you're willing to lose on any given trade, and never risk more than, say, 2% of your equity on any single trade. It's all about protecting your capital for the long run.
Got it. Protect the capital. Let's talk strategy then. How do traders combine these analytical approaches into actionable plans?
Well, for technical trading, multiple time frame analysis is really powerful. You identify the big picture trend first, maybe on daily or hourly charts. Then you use a shorter time frame, like a 15-minute chart, to pinpoint more precise entry levels. For example, if, say, CHF-JPY is in a clear downtrend on the daily and hourly, you might look for chances to fade. That means bet against short-term upward bounces on the 15-minute chart rather than buying into them.
Okay, using different lenses.
Exactly. There are also specific strategies for certain market conditions. Inside trading, for instance, that involves placing orders just above the previous day's high or just below the low, anticipating a breakout. often with a stop and reverse order to catch false breakouts and capture reversals if they happen.
What about trading around those big news events like the non-farm payrolls we talked about? That sounds like a high-stakes, high-volatility situation.
It definitely is, yeah. There are basically two main approaches here. Proactive trading means entering a position maybe 15 to 20 minutes before the number is released. You're aiming for a good risk reward from that initial price spike. The obvious problem is predicting the data correctly is really difficult.
Gambling almost.
It can feel like it. The other way is reactive trading. You wait for the actual release and only pull the trigger if the data is significantly different, better, or worse than the forecast, like a big surprise. A combined approach can sometimes be best. Maybe initiate half a position proactively if you have a really strong, educated guess, then add the second half after the release if your initial view turns out to be correct. This kind of reduces your risk if you're wrong initially, gives you a chance to adjust.
Interesting hedge. And on the fundamental side, what are some more advanced strategies? Moving beyond just interpreting the latest economic report.
A key fundamental strategy is picking the strongest pairing. Many traders focus too much on just one currency, maybe the dollar or the euro, but it's vital to consider the relative strength and weakness of both currencies in a pair. For instance, after a strong US dollar move, maybe the British pound rebounds quicker against the dollar than the Japanese yen does, especially if Britain's economy looks consistently strong while Japan's is struggling. Finding that kind of strong economy versus weak economy pairing can potentially maximize returns.
Looking for mismatches.
Exactly. Also, staying on top of macroeconomic events is critical. Big picture stuff. Large-scale events like wars, major international meetings like the G7 summits, or even natural disasters can reshape fundamental perceptions for months, sometimes even years. Remember that G7 meeting back in September 2003? The U.S. trade deficit was a huge topic. Well, that led to an 11% fall in the dollar against the euro over the next 5 months. That's what, 1,100 pips? These major events create massive opportunities, both appreciation and depreciation, for traders who can anticipate their impact. Deep dive into major currency profiles.
Right. So each major currency seems to have its own unique characteristics, almost like a personality. Can you give us some quick highlights? What makes them distinct, and what should traders kind of know about each one? We'll start with the big one, the U.S. dollar.
Okay, the U.S. dollar. Still the world's leading economic power. Even though it's largely service-oriented now, its manufacturing sector is still significant, making it sensitive to developments there. It has the most liquid equity and fixed income markets globally, absorbing, I think, over 70% of total foreign savings.
Yeah.
And but it runs a massive current account deficit. Needs billions in capital inflows daily just to prevent decline. And as we mentioned, its value often has that inverse relationship with gold, the anti-dollar. When the dollar weakens, gold often strengthens.
Okay. What about the euro? Relatively newer currency facing its own unique challenges.
Yeah, the euro faces unique hurdles precisely because it's exposed to the economic, political, and social winds of, many member countries. While it is gaining ground as a reserve currency, the European Central Bank, the ECB, has that tough job of setting monetary policy for all members. This often leads to political friction, like when the ECB might need to hike rates for the whole zone, even if one specific member state is maybe struggling with a domestic recession.
Tricky balancing act. And the British pound. What makes it tick?
The British pound, or sterling, it benefits from having arguably one of the most effective central banks, the Bank of England, and a strong service-oriented economy. A unique characteristic is its sometimes positive correlation with energy prices. The UK is a major natural gas producer and exporter, so global energy market shifts can definitely influence the pound.
Interesting. Now, the Japanese yen has that fascinating history with its economic bubble and consistently low interest rates.
Yes, the Japanese yen, still somewhat influenced by the legacy of its 1990s asset bubble collapse and the banking crisis that followed. Banking sector stocks there are still closely watched because of that history. It's very often the primary currency sold in carry trades because of those persistently low interest rates. Remember, that's borrowing in a low-interest currency like the yen and investing in a higher-interest one. Also, its price can sometimes be volatile during what traders call Japanese lunchtime, roughly between 10 and 11 p.m. U.S. Eastern Time. Market liquidity can temporarily drop then, leading to some sudden moves.
Good to know. How about the commodity currencies we touched on? Australia, New Zealand, Canada.
Right. The Australian dollar, Aussie, is highly sensitive to global commodity prices, especially things like iron ore and coal. Its economy can also be susceptible to drought, though it typically tends to recover strongly. The New Zealand dollar, Kiwi, shows an almost perfect correlation, like 97% positive, with the Aussie dollar. Australia is its largest trading partner, so they very often move in tandem. And the Canadian dollar, loonie, has that extremely close trade relationship with the U.S., making it very sensitive to the health of the U.S. economy. It's also a popular carry trade currency, sometimes paired against the yen, similar to the Aussie or Kiwi. Outro.
Wow. What a deep dive into the foreign exchange markets. We've really covered a lot of ground, from its distinct advantages over equities to pivotal historical moments, what truly moves currency prices, and how a disciplined trader approaches this really dynamic world.
Yeah, we've seen how understanding not just the hard numbers, but the underlying economic narratives, the subtleties of global capital flows, and even the psychology of trading is absolutely key. It's clear the FX market is an incredibly complex, multidimensional ecosystem, just countless moving parts.
So what does this all mean for you, our listener, now that you've got this comprehensive overview? The mechanisms, the history, the market movers, the strategies.
Well, maybe something for you to mull over. Consider that while economic indicators and fundamental theories are crucial, absolutely, those soft factors like market sentiment, political developments, even a central bank's unexpected unannounced intervention can sometimes override what seem like logical movements based on the data. So the question is, how might you integrate those less tangible elements into your understanding of currency movements? Building on all the detailed information we've just covered,